This video will explain at a very basic level the concept of stocks and shares. Let's start with an example of a small company. Emily has a small cupcake bakery in London called Emily Bakes. She wants to scale up her business and open up more cupcake bakeries, so she needs more money. In this case, to scale up her business, we call money capital. She needs to raise more capital to open up more bakeries, pay rent for these new bakeries, pay wages of new staff, and pay for new cake equipment. So Emily raises more capital by going public. Going public means that Emily Bakes will sell tiny pieces of the company, known as shares, to the public by listing on a stock exchange. When a company sells its shares to the public via a stock exchange, this is known as an IPO, an initial public offering. So Emily lists Emily Bakes on a stock exchange. She has 10,000 shares to sell. Each share costs £5. This price was set by an investment bank who evaluated Emily's business. Being listed on a stock exchange massively increases the profile of the company Emily Bakes to investors. But why would investors want to buy shares? One of the reasons Sam wants to invest in Emily Bakes is because he thinks he can get a good return on his money through capital growth. In other words, he believes that Emily Bakes is going to become so successful that the shares he buys, costing £5 each, will shoot up in the future, meaning that he can sell them at a higher price and get a return on his money. So Sam buys 1,000 of Emily Bakes shares. This means that he now holds a 10% equity stake of the company Emily Bakes, and he's now also a shareholder in the company, as he has bought some pieces of Emily's company. If Sam's estimation is wrong and Emily's company does not become a financial success, no one buys Emily's cakes, then Emily's shares will fall due to people not buying her product. Therefore, she'll have no profits, meaning she'll have to lay off staff, and her company will eventually collapse, causing Sam's shares to fall in value. This is why investing in the stock market always carries risks. Shares can go up, but shares can also go down. So there we have it. Investing in the stock market is buying or selling units of a company based on how much people think those units will be worth in the future.